This is the projection every new investor is shown. It suggests that a tiny initial investment, left alone over 40 years, will eventually enter a near vertical climb into millions of dollars. But for a typical beginner's budget, the math feels much slower. If you put $50 a month into a standard index fund, earning an average 8% return, your total profit after 12 months is $4. $4. You probably spent more than that on a single cup of coffee while you were checking your portfolio balance. This is where most people quit. When you do everything right, saving diligently and leaving the money untouched, only to see virtually zero progress, it often feels like the system is rigged or the charts were a lie. Compound interest is real, but it has a strict size requirement. Because your starting capital is small, the returns are mathematically too low to notice. This makes your first decade of wealth building a test of psychological endurance rather than financial gain. To understand why early investing feels so stagnant, we have to look at the numbers. Percentages do not pay for groceries, only total dollars do. This comparison shows the real-world impact of the exact same interest rate on different piles of cash. 8% of $50 is a nearly invisible $4 sliver, but 8% of $100,000 is $8,000. Same rate, different life. Because that $4 return is so small, frustrated beginners often misdiagnose the problem. They assume their interest rate is too low and decide they need to find a faster investment to speed things up. They abandon reliable index funds and start chasing double-digit returns by pouring money into volatile assets, hoping speculation will solve the problem of a small starting balance. Look at the math of this trap. If you somehow double your return, from 8% to 16%, while investing $200 a month, you end up with about $52,000 after 10 years. That's a $15,000 gain for risking your entire portfolio. Now, the safer path. Keep money in a steady 8% fund, increase your deposit to $350, and reach $64,000. More money, zero extra risk. In your first 10 years, chasing market output is a dangerous distraction. Pushing more of your own money into the system is the only reliable way to build the mass required for the math to work. To know when the struggle ends, you need to track the contribution versus return split. This ratio determines who is doing the actual work of growing your wealth, you or the market. This is phase 1, the contribution era. Early on, your manual deposits account for roughly 83% of your portfolio's growth. The market's interest only provides the remaining 17%. But if you keep adding cash, you eventually hit the wealth threshold. This mathematical tipping point generally occurs when your invested balance crosses between $100,000 and $150,000. At $100,000, an 8% return generates $8,000 a year. That is $667 every single month. Your money is now generating more cash than your original $200 deposits. You have entered phase 2, the compounding era. The ratio flips. The interest slice swells to dwarf your own contributions, and your portfolio begins to snowball on its own. The invisible progress of those early years is not a sign of failure. It is a mandatory phase. Every single investor has to manually roll the heavy snowball themselves before gravity and momentum can take over. To succeed, you have to view compound interest differently. It is not a strategy you deploy on day one. It is the reward you earn for surviving the contribution era. The fastest way to reach that reward is to automate your investments as a non-negotiable bill. If you only invest what is left over at the end of the month, you are relying on willpower rather than a system. Small increases create massive results. Investing just $50 more every month at an 8% return creates a $29,000 pillar of extra wealth over 20 years. You can also accelerate the timeline by trapping your raises. Whenever your income increases, route 50% of that new money directly into your investments. You still get a lifestyle boost, but your path to the threshold speeds up. Your objective right now is to build sheer physical volume. You are accumulating the raw mass required for the percentages to become meaningful. It is difficult to watch your account inch forward while others post about passive income. But social media only shows you the finish line. It rarely shows the years of boring, invisible deposits that made those results possible. During these early years, the math is working silently beneath the surface. You cannot see the pressure building, but you are laying the foundation. Wealth accumulates when you relentlessly feed the math until you reach the threshold where the math starts feeding you.